Well, I suppose I have two approaches. One, I like to sort of punt a bit, but that's only with a very little bit of my money, and then the rest of it I like to have a very sort of stable approach, because having spent so long saving my money, I don't really want to throw it away.
Well, the key thing for me is I'm doing it for the long term. I'm not trying to see a return in a few months or anything. I'm doing it for my kids, for retirement and for the future. So that governs my approach, really.
I have to take account of my age these days, that I can't necessarily fool around with money, so I tend to take a more conservative approach, buy things which don't necessarily give high return but will give a nice consistent return, and of course look after the capital.
Hello and welcome to Stocktalk, Self-Trade's regular programme discussing investments, markets and financial planning. This edition gets back to basics with a look at the stock market itself and approaches to investing. We'll be examining how the stock market works, what to look out for when selecting shares, and asking what are the benefits of building balanced portfolios. Over a century or more, stocks and shares have outperformed pretty much every other asset class, including bonds, gold, and even property. And it may be the place professionals go to invest, but the stock market has never been more accessible for the private investor. Price, performance information combined with modern dealing platforms make investment decisions as well informed as ever. But investment choices still require some thought and judgment. The stock market works like any other competitive market, matching buyers and sellers and pricing the companies listed. As a shareholder, you are part owner of that company and can profit in two ways. Firstly, as the valuation or market capitalization of your stock increases, then so too will your holding be worth more. Bear in mind, though, that values can also fall. Secondly, you're entitled to a share in the profits, and these are distributed by way of a dividend. Some of the most profitable long-term portfolios are built upon reinvesting these dividends. How you approach investing in the stock market will depend on the type of investor you are, and this programme is designed to help you decide just that. Over the next few minutes, we'll be talking to Mark Glowrey of Investors Intelligence and giving you our stock market insight. But first, here's our quick introduction to investing in shares. Shares in public limited companies, PLCs, are quoted on the stock market, and this means almost anyone can invest in them. Shareholders can be individuals like you or me, or is often the case, especially with bigger companies, institutional holders such as pensions or collective funds. So how should investors go about selecting stocks, and what are the risks? So are shares risky? Well, shares should be considered a higher risk instrument, certainly more so than cash, bonds or other collectives. And some shares are riskier than others. For instance, very small companies can be less stable than the so-called blue chip, bigger companies. But quoted shares are limited liability, meaning that the risk of being a shareholder is limited to your investment outlay. You can only lose what you've invested. The way that investment works is that the higher the risk, the higher the potential returns. So shares are riskier than cash, but that risk is compensated for by superior long-term returns. You need to have a good idea of your tolerance to risk before you begin to invest. Don't invest in shares that keep you awake at night, and mitigate against the risk by diversifying and using collectives such as investment trusts or unit trusts. If you put all of your money into the shares of just one company, you expose yourself to the risk of that company falling from favour. By investing in two companies, the stock-specific risk is halved. With 4 companies, it is a quarter of what it was. Building a diversified portfolio of shares, markets and sectors help to reduce the risk of investing. As the world gets smaller, the share or equity markets available to private investors is getting bigger. And the choice available to investors means not only geographic indices, but also market sectors such as telecoms, oil, pharmaceuticals and energy. A portfolio might include shares from the UK, so the FTSE 100, 250, All Share and AIM. It might include international shares such as the Dow Jones and Nasdaq in the US, or the German DAX, or the French CAC 40 in Europe. So, what sort of investor are you? Here are 3 distinct types that might help you decide. Value investors seek out the hidden value that they think the market has missed. They look for undervalued stocks and wait for other investors to reach the same conclusion. Value investing is only really possible in inefficient markets. Where a market is efficient, where there is near perfect information, stock will not be undervalued but will trade at levels that the market considers to be fair value. In the larger blue chip markets like the FTSE 100, many investors, analysts and researchers operate, making the market largely efficient. although the market is always affected by fashions and fads, so ignored sectors and stocks may still offer value. Value is more often found amongst the smaller companies, because poor liquidity makes it difficult for institutional investors to buy, and so there will be no need for analysts to track these companies. Smaller companies are generally the preserve of the private investor, but they represent higher risk. Growth investors select quality stocks that they believe will achieve superior returns over the longer term. A growth investor is therefore content to buy stock towards the top of its range. The risks involved in growth investing are lower than that of value investing, but the potential may be less spectacular. Contrarian investors are a breed apart and count amongst their ranks some of the greatest investors of all time. Contrarians analyse stocks and companies forming a view of their potential irrespective of what the rest of the market is doing. It does not always mean doing the opposite of what the market does. After all, sometimes the market is right. So, the benefits of investing in shares are their long-term growth potential, ability to achieve diversification, and ease of buying and selling. For a first-hand perspective on share trading, we spoke to Mark Glowrey of Investors Intelligence. I started by asking him what sort of investor he was.
I have several pools of investment, some of which are for the longer term, some of which are for the shorter term. I have a SIP, which is the aim of which is to provide for my pension, and that is very much aimed for the long term. I have some ISAs, which are perhaps of a medium-term nature, and then I have a trading portfolio, which is basically for punting, as I would call it.
And does that mean there's also a difference between short-term investing and long-term investing?
I think very much so. With long-term investing, you're really looking to lock into the capital gains, which will be the product of the growing cash flows and profitability of the economy and specific companies over a long period of time. With shorter-term investing, you're really talking about trading, which is really the speculation on price movements, and that could be quite independent of the fortunes of a specific company or a specific or the economy on a fundamental basis.
How important is it to diversify your portfolio?
I would say absolutely vital. If you are starting a portfolio with a relatively small sum of money, maybe between £100 and £1,000, you might actually be better off starting with something like an index tracker fund that will create that diversification for you, because the fund manager will go out and buy 100 different shares in a FTSE tracker. Once you get a little bit more, maybe you have £10,000 or so, you can then afford to go and buy perhaps 10 different shares in 10 different areas, at which point your risk has been reasonably well spread.
So Mark, any personal tips on investment styles?
Most people are fairly well versed in the concept of conventional diversification. First of all, they diversify by asset class. So for instance, they might have some cash, they might have some bonds, they'll probably have some equities, and they might have some overseas equities, which we touched upon earlier, and that is well and good. But there is also a case for what I call technical diversification, which is to try and pick a range of stocks that show different but positive technical characteristics. And there are three main categories here. The first is the breakout category, and these are the super powerful stocks that are pushing to new highs. So at the time of speaking, we'd be looking at stocks, perhaps in the mining sector, some of the utilities. We'd also be looking at selected overseas markets, such as India, which is continuing to show great strength. So that's the first type of category, technical diversification. The second is the consistent uptrend. So you look for a stock that is in an uptrend, possibly pulling back from it, but still holding above, say, its 200-day moving average, or the positive pattern that it will have exhibited over the longer term. And by the longer term, I mean 18 months plus, hopefully 5 years. That is the kind of stock you want to try and buy on the retracement for looking for the reassertion of that underlying strong investor sentiment. And the third type is the base formation, looking for those oversold stocks which have had very sharp declines, but which are now starting to recover. They might have seen a downside acceleration, a final sell-off. They're now trading sideways. They haven't pushed to lower lows. these are the recovery candidates. But if you mix these three types of formations, it's a useful play. You won't be getting sucked into a large amount of overvalued assets. You won't be trapped into the situation, and a lot of investors can do this, of buying a lot of dead ducks that are never going to be bouncing. And you've also got the middle category as well. So it's something I use myself, and I can recommend it.
So, we've learned about how the stock market works and the benefits of investing in a portfolio of shares. It's time for the Stocktalk Insight.
The price-earnings ratio is one of the most useful measures of a share's expensiveness. It is calculated by dividing the share price by the earnings per share. It can tell you both that a share is cheap or expensive, or if you're looking at the company from a different perspective, it can tell you the confidence the market has in its growth potential. This is because the PE gives you a multiple of company's earnings. How many years of earnings is reflected in the share price. It's neither good nor bad to have a high or low PE, but it helps you to make a judgment. A low PE might tell you it's cheap, or conversely make you worry that there's a problem with the company. Similarly, a high PE might lead you to dismiss the stock as too expensive or give you confidence in the market's strong valuation. It depends what type of investor you are. Remember to compare like with like. Different sectors will have different multiple norms. The charts are always a good place to start looking at shares. They indicate momentum, trends or sentiment and give buy and sell triggers. Chartists learn to recognise patterns. Simple patterns include trading range breakouts where resistance and support levels are identified. Moving averages are another. By identifying longer-term moving averages, investors may be warned of possible buy signals or golden cross. This is where a rising short-term moving average crosses a rising medium-term moving average. Sell signals or dead cross occur where a falling short-term moving average crosses a falling medium-term average. We will cover technical analysis in a future programme. In the meantime, the technical analysis microsite is available from the research section of the Sell Trade site. Shares bought on the stock exchange are said to be on the secondary market. They have been owned before, although their value is not affected by being second-hand. Many investors seek new issues or IPOs, initial public offering, where companies listing for the first time offer their shares to potential new shareholders. Since the number of investors is limited, there can be a demand on the first day of trading. Those who choose to sell quickly are said to have snagged the issue. Others find that getting in at entry level is one of the best ways of building a portfolio and benefit from not paying stamp duty.
Well, that's it for this edition of Stocktalk. I hope you found it useful. If you'd like more information, call customer services who will be happy to help. And if there's any topics you'd like covered by the programme, please email me at the address on the screen. Thank you for watching.